If you are a self-employed, a business owner, a high earner, or a real estate investor, and you find that buying a home can be a little difficult because there aren't a lot of loan products out there for us, I have something for you. It's called the non-QM loan. You might want to check out this video.
The biggest crush ever branded on my brain. When I laid eyes on you back in the 6th grade. My first dream girl called her Ella Jane. She might have never.
When people talk about being an entrepreneur or being self-employed or a business owner, there are a lot of things that probably do not come up in conversation. And one thing that you will find, especially in the mortgage space, is you'll find that a lot of times you will not qualify for a loan because you do not fit that box. You're not fitting that box. So what happens is you go to your local bank and they tell you, unfortunately, we do not have any products for you because we have to look at your tax returns. We can't just look at your gross income. We have to look at your net. We have to go through all your tax returns and just see exactly where you're spending your money. And for the most part, get permission in order for you to purchase a home or looking to purchase a real estate investment property. But with the non-QM loan, is basically built for the person that's self-employed. That's built for the person that does not fit that box. And it makes it so much easier for you to be able to make the purchase. So let's take a look at a couple of things. So let's look at the definition. So if you just look at the non-QM loan, it's basically, it does not conform with your traditional type of loan products. So you have Fannie Mae, you have Freddie Mac that's out there, and you have what they call the CFPB, and they control what type of lending that we do. They set guidelines for our lending. With non-QM, it's kind of like a lender's perspective. So if they want to lend the money to a person that's self-employed, that do not want to show the tax returns, they have all the ability to do so. And the way they do that is they use something what they call, I like to call common sense type of lending. So if you have the credit for it, if you have the down payment for this particular type of loan, and you can prove that you are truly a business owner, then you, for the most part, will qualify for these type of loans. So I want to go through just a few that I really like, that I run into quite a bit. There are a lot of different, options or scenarios out there that I don't see a ton, but let's just start with someone that's self-employed. Okay, so someone that's self-employed, such as myself, you'll go into a bank and you know that you will qualify for a loan if they were to look beyond your tax returns. So this right here gives you an option to not use your tax returns at all. One of the main ones I like to use, actually two. One would be the bank statement. So these days you can use 12 months up to 24 months. It all depends on your qualifications. And if you have personal and your business, use both. So you could combine the two and make it a little bit easier for you to qualify for a loan. So if you own your own bike shop, right? You've been in business for, let's just say 3 years, and you're bringing in anywhere in the range of, let's say $20,000 a month. Depending on how we structured that loan out for you, if you make $20,000 a month and we use 50% of the deposits that's going into your account, we could use up to $10,000. Now, if you really want to increase that amount, if you had your CPA or someone that does your taxes that can do a letter for you to show that, look, this is what this person is making, like a P&L, then we can actually use the higher amount. So we want to give you the benefit of the doubt. Sometimes people they do not like to go that route. They just want to just use whatever the 50% is. But if we need to use more, we can do that. Because as we know, if you're bringing in $20,000 a month, you can't use all the money. We know that you do own a business, so we can only use a certain amount of that. But we do have a ratio that we use, and most lenders will use about 50% of the total deposits that you have coming into your account. The benefit of going that route is it's away from you just using your tax returns. As you know, your tax returns, there's a lot of write-offs that's there. There's depreciation that's there. So there's quite a few different things that can possibly reduce your income. And in this situation, you want to use as much income as you can possible. So that would be if you use a bank statement type of a loan. Like one of my favorites, you just send us your bank statements. We'll do the analysis for you, and we'll let you know how much you will qualify for. And you can buy a primary residence, you can buy a secondary home, or an investment property using these type of bank statements. All right. The other one I would say is your 1099. So if you are a 1099 entrepreneur or independent worker, you can use 1 year of 1099s, you can use 2 years of 1099s. It just depends. So what you would do is you'll get with someone like myself and we'll take a look and see, okay, how much did you make 2 years ago? How much money did you make last year? And we'll look at your scenario to see how would that work. And the same thing, if you want to prove that you're making more money than that, as long as you have a letter that can prove that you're making more money than even what you're showing on your 1099, say you have some other things going on, as long as a CPA, someone that's certified, can sign off on that letter, we, for the most part, can use those higher funds. So that's it, your bank statements, your 1099s, and also your P&L. So if you are self-employed and you have P&L, most people do their P&L just quarterly. So depending on how much time that you've had in this particular year. So right now it was April, it'd be April tomorrow. So we're going into April. So January through April, you use portion of the year. And say you use all of last year and you turn that into us, we could take a look at it and we can see how much you will qualify for using just your P&L versus your tax returns or your 1099s or your bank statement. So as you can see with non-QM, we're giving you a lot of options here. So it just depends on which option will work better for you, but at least you have that as an option. Just think about it. If you're W-2, there's only one way to go. You have to use your W-2 income. We'll look at the last 2 years of your pay and also your pay stubs. So we're doing an average and we'll tell you exactly how much you can use. Now, you're still using the gross, but it's not like you've been a business owner where you have all the write-offs, you have the different tax returns. There's a lot more complexities that goes on within a self-employed business owner. We want to make sure that we are giving you something that makes sense for you and your family. So like I said, that would be your bank statements, 1099s, and P&L for 1 or 2 years. All right. One group of people that I see as well outside of just being self-employed, and self-employed will go into with this as well, is your real estate investors. So if you're a real estate investor and you find that you want to apply for like a hard money loan, or you want to apply for a long-term loan for your rentals, you can do that. And I know a lot of times when I speak to a real estate investor, like, I wouldn't qualify because I can't show my tax returns. That is great. You can do the same thing. Different options. So you still can use your bank statements. I have real estate investors that still use their bank statements, which will be fine. So as long as you have the flow of deposits coming in every single month and it makes sense and it's consistent, then we'll use your bank statements. The other option would be one of my favorites, if you see the look at my face, is the DSCR loan. So the debt service coverage ratio. So as long as the property cash flows, then we will not look at any of your income, none whatsoever. So bank statements will not apply, tax returns will not apply. We're using the cash flow of that property. All right, you have a property, you purchased it or you want to purchase it, and the mortgage itself is, just say, is $3,000 a month, but your rental that you're receiving in rent, say it's $3,500 or $4,000 a month. That is all the lender needs to see. They just want to make sure that the property cash flow is not going to be any type of high risk to the lender and you yourself, of course. But they want to make sure that there is going to be any foreclosure, any type of short sales, anything like that, because you properly vetted that property. So we're going to do the same thing. So once you find the property that you want, the house will get appraised, and say there's no one that's living in the property now, right now at this time, then what we'll do is we'll pull a rent roll. So the investor, the appraiser, is going to take a look at that property, and they'll tell us, looking at the market analysis, how much do they expect you to make off of that property? Or if you have a lease that's currently already set up with that home, you could use that as well. So as long as the rent itself is more than the mortgage payment, that's all you need to qualify. Like I said, that is one of my favorite products to use. And with the DSCR, the debt service coverage ratio, you can use those with long-term rentals, so your traditional rental, and your short-term rental, so that'll be your Airbnb, all those situations. So we have the options for you. As you can see, you're outside of the box. You're not just in that little box where you have to go conventional or FHA or VA. This will take a look at your situation, and we can make a decision which direction we would need to go in order for us to move forward with your loan. So that's for your real estate investors. Like I say, you can use that for your long-term and short-term rentals. And also with non-QM, we have access to hard money funds too. So if you're looking at a property and you're trying to make an acquisition, so you want to buy the property as is, we have the means of doing that. Non-QM will allow you to do that. So it's going off of what they call the B.R.R.R.R. So that's buy, rehab, rent, refinance, repeat. A lot of investors use this so they can buy the property. So use your hard money loan, you do the rehab, all the rehab goes on loan, goes into the property. Once you're done, then you'll rent that property out. Once it's rented out, you know exactly how much you're gonna make on that property, or right before, we'll do a refinance, because you have to take yourself out of that short-term loan. That's how that works. Now you'll refinance with that, and then you repeat. So you do the same exact thing. And this would allow you to do a cash out too. So say you have properties where it's a lot of equity involved in that property, you can do a cash out with the DSCR as well. Take that cash out, use that as a down payment, or use that to purchase your next property, and you continue to build up your portfolio from there. So just different ways of doing that. So like I say, you can do the bank statements, you can do the DSCR, and you can do the hard money loan if you want to purchase properties. And you can also do fix and flips. So if you're gonna buy the property, fix the property up, and flip it, you can do this the same exact way. Another one that I see quite a bit, especially for my Florida folks, your ITIN borrower. So that would be your individual taxpayer identification number. So if you have that card, meaning that you do not have a social security number and you want to purchase properties here in the US, which is real big right now, to say the least. So if you want to purchase a property here and you are ITIN, you can do so, but you gotta go the non-QM route. This is the easiest way of doing that. So this will allow you to still come to the table, put down your down payment, and as long as you have the reserves, because a lot of times it is a reserve requirement that's involved, you can still purchase property. So that could be your primary residence as well as investment property. So if you have any questions about that, let's talk about that. So let's go over a few things that will make the non-QM a little different from a lot of different loans. One would be no score, or one score we can use, but non-QM product. You can close this loan in LLC. So this is really good for the real estate investors that find properties and they do not want that property in their personal name. You can actually use this product and put you into a LLC. And when we pull credit, or say another lender pulls your credit, it will not show up under your personal credit. Now, there are some lenders that still would show that on your personal credit. So you got to be careful what lender you use for that. Your higher debt ratios, so debt to income ratios could be higher with the non-QM. No MI, no mortgage insurance, no tax returns. We do not need your tax returns in order to get these loans to fund. And no income, no employment. That'll be the DSCR transaction. So if you say you didn't have a job, but you had a property that cash flows, that's your income. So we can use that for the income that would be needed. All right, so just a few things that stand out about these products that will still make a difference. And I can't say pros and cons. So this is for that borrower that has down payment money. So expect to put at least 15 to 25% down. All depends on what you qualify for and your qualifications. Reserve requirements, you expect to have 3 months to 12 months, and sometimes 24 months of reserves. So you gotta have reserves that are there in order to qualify for a lot of the non-QM products. The ideal score, I've seen some that go as low as 620. I would say 640 to get more of a better average, because you want to be in a situation where you can qualify for majority of the products. But there are certain loan products where your credit score has to be a 700 and above, sometimes 680. But the benefit of working with the broker is we have a lot of lenders that we can use. So if that is your situation, we'll find the lender that will work for you. And the last thing, and especially in this market, everyone asks about rates, right? So the rates are going to be slightly higher because it is not necessarily a higher risk, but we're not going through all your documents. So there's got to be some give that's there. So they're going to charge you a higher rate. So right now, if the rates are at 6.5%, expect to pay maybe 1%, 1.5%. It just depends. And it heavily depends on you as a client. So if you have higher credit scores, if you have more reserves, it may not hit you as bad. But the point is, you have to look at it from this standpoint. If you were to purchase a home and go the conventional route, and you had to put down 15 to 20%, your credit scores had to be at a certain amount, and your tax returns had to be 100% buttoned up with no issues, no problems. And if you qualify with your net income, then yeah, you went conventional, it may work out better for you. But a lot of times when people are self-employed, it's a lot more complex than that. So instead of you showing all of your taxes or making adjustments to your tax returns and you spending $60,000, $70,000, $80,000 more in your taxes just to qualify for your house, this may make a lot more sense because it's easier to do. A lot of times these loans close a lot faster, and we're not going through all of your documents. So we'll say, all right, since they're putting down a larger down payment, the credit scores are here, they have reserve requirement, we feel comfortable enough with this buyer that we do not need to go through the tax returns that have them approve how much money they made throughout the year. So as you can see, there's a lot of options when it comes to non-QM. I didn't hit all the ones that are out there, but there are just some great programs out there for us. Like I said, for your real estate investors, people that are self-employed, that on the primary, secondary investment properties, people that are ITIN, that usually can't qualify for a lot of different loan products unless they have some special portfolio loan at the bank that you bank with. But normally you would not be allowed to do that. But with the non-QM ITIN, you're allowed to still purchase that property, still purchase that investment property. So as long as you have the ITIN card and you have the reserves and the credit scores, then you can still purchase a home. So I wanted to touch on this, and I'm going to continue to go through the non-QM. Is like one of my favorite products to use because of the ease of use. And I see in 2025, there's more people that's self-employed than ever before. I mean, especially after the pandemic, there's a lot of people that went in business for themselves, and you would not qualify for that traditional product. So what the lenders did was all right, we had to find something that would work. And non-QM has been around for a long time, and is not a subprime loan. I hear people do it all the time, try to describe it or compare it to subprime. Subprime was its own animal altogether. As long as you had a heartbeat, a pen, and the business card, that's all you needed to qualify for subprime. We're still looking at reserves, we're still looking at credit scores, we're still looking at down payment, and they perform very well on the secondary market. If you do some research on that, you'll see that non-QM loans perform very well on the secondary market. So it is a very safe loan to take on as a new buyer or a seasoned buyer. So if you have any further questions, like I said, I'm continuing to make more videos about the non-QM, and I may even break them down into sections because I could do one strictly on people that's self-employed for a whole hour, or someone that's looking to use it as a real estate investor, different ways you can use it. So we may do that. So let's break these things down to see, okay, what type of scenarios I'll find myself into where I think that I may want to use a non-QM loan. So that's all I have for you today. Thanks for checking out the Mortgage Motivation Podcast. And let's continue to build this community. Every single week, I will continue to bring out more products, more programs, anything that's going to relate to you as a buyer. And if you have like products that you had never heard before, you want me to explain it, please reach out to me and let me know. Hit me in the DM or just leave me a comment. I'll respond. And I actually respond to the comments. So leave me a comment and we'll take it from there. All right, you guys have a good day. Peace.